Hey everyone, welcome back to Boni's Life. I'm Boni, and today we're diving deep into the most current developments in the global economy as we move through the second half of 2025. If you thought the economic landscape was volatile in the first half of this year, the latest data from July reveals even more dramatic shifts that are reshaping the entire global economic order. Since our last comprehensive analysis, we've seen significant developments that are fundamentally altering the trajectory of the world economy. The International Monetary Fund has just updated its forecasts. China has released surprising GDP data, and central banks worldwide are making moves that will impact every aspect of our financial lives. Understanding these latest developments isn't just about staying informed. It's about positioning yourself for what's coming next. The decisions being made in Washington, Beijing, Brussels, and other major economic centers right now will determine job markets, inflation rates, investment returns, and even the prices you pay for everyday goods for years to come. By the end of this video, you'll have the most up-to-date picture of where the global economy stands in July 2025. What the latest data means for different regions, and most importantly, what it means for your personal financial future. Let me start with the most significant development that just emerged from the International Monetary Fund. On July 18, 2025, IMF First Deputy Managing Director Geeta Gopinath announced that the fund will be releasing an updated global economic forecast later this month, and the preliminary signals suggest some cautious optimism mixed with persistent warnings about trade tensions. Here's what's particularly striking about the IMF's latest position. While they're preparing to potentially revise their April forecasts slightly upward due to what Gopinath calls front-loading ahead of tariff increases and some trade diversion, they're simultaneously warning that downside risks continue to dominate the outlook and uncertainty remains high. This represents a fascinating paradox in the current global economy. We're seeing short-term economic activity boosted by companies rushing to import goods before higher tariffs take effect. But this artificial stimulus is masking deeper structural problems that could manifest later in the year. The IMF's April forecast had already slashed global growth projections to 2.8% for 2025, a full half percentage point below their previous estimates. This was primarily due to U.S. tariffs reaching 100-year highs and escalating trade tensions. Now, economists are expecting a slight upward revision when the updated forecast is released, but this improvement is largely technical, driven by temporary factors rather than fundamental economic strength. The United States economy continues to present a complex picture that defies simple categorization. S&P Global's latest analysis, released just days ago, confirms that several of the key predictions for 2025 are materializing, including the anticipated U.S. economic slowdown. The first quarter GDP contraction of 0.5% that we discussed earlier has been followed by what S&P Global describes as a rebound in the second quarter. Though their tracking estimates suggest very subdued quarter-over-quarter growth in real GDP on average during the first 2 quarters of 2025. What's particularly important to understand is that the first quarter contraction wasn't necessarily indicative of fundamental economic weakness. According to S&P Global's analysis, it partly reflected an exceptional surge in imports due to tariff front-running. Companies were essentially pulling forward their import schedules to avoid higher tariffs, creating a temporary distortion in trade flows that artificially depressed GDP calculations. However, the underlying factors that S&P Global identified as drivers of U.S. economic weakness remain very much in play. The lingering effects of prior monetary tightening, dollar strength, diminished fiscal tailwinds, and the ongoing impact of higher tariffs on business costs and consumer prices. The Federal Reserve's position has become increasingly complex. As of the latest reports, the Fed is expected to hold its benchmark rate steady in the 4.25% to 4.5% range at its July 29th to 30th meeting. This represents a significant shift from earlier expectations of rate cuts, with Fed officials now viewing current rates as at least moderately restrictive, but necessary to combat potential inflationary pressures from tariff policies. Interestingly, there's growing division within the Federal Reserve. Fed Governor Christopher Waller has made what Reuters describes as the strongest call yet for rate cut in July, arguing that the Fed's policy rate should be 3%, which would represent a 125 to 150 basis point reduction from current levels. However, this position appears to be in the minority, with most Fed officials preferring to maintain current rates amid concerns about tariff-induced inflation. Perhaps the most significant positive surprise in the global economy has come from China, which released comprehensive economic data on July 15th that exceeded virtually all expectations. China's economy grew 5.3% year-on-year in the first half of 2025, with second quarter growth of 5.2% that, while slightly slower than the first quarter's 5.4%, still beat market forecasts. This performance is particularly remarkable given the external pressures China faces. The country is dealing with U.S. tariffs, global trade tensions, and significant domestic challenges, including a persistent real estate crisis. Yet the economy has demonstrated what analysts are calling surprising resilience. The composition of China's growth tells an important story. Industrial output expanded by 6.4% in the first half of the year, with manufacturing leading the way at 7.0% growth. High-tech manufacturing grew an impressive 9.5% year-on-year, while equipment manufacturing expanded by 10.2%. These figures suggest that China's economic transformation toward higher value manufacturing is continuing despite external headwinds. Services sector growth of 5.5% year-on-year indicates that domestic demand remains relatively robust, though retail sales growth of 5.0% suggests consumer spending is more cautious. Fixed asset investment rose 2.8%, with manufacturing-related spending providing a particular boost. However, beneath these headline numbers, challenges persist. The real estate sector continues to struggle, with investment falling 11.2% in the first half of the year. Chinese officials acknowledge that the real estate market is still bottoming and requires stronger support. Additionally, China faces significant deflationary pressures, with the GDP deflator down 1.2% year-over-year, the sharpest decline since the global financial crisis. S&P Global has revised their China forecasts modestly upward, from 4.3% to 4.5% for 2025 and from 3.9% to 4.0% for 2026, though they still project a slowdown in the second half of 2025 due to higher tariffs and diminishing policy stimulus effects. Europe's economic performance continues to disappoint, with the region facing what analysts describe as a perfect storm of challenges. The European Union is projected to grow just 1.0% in 2025, with the Eurozone expected to expand by only 0.9%, figures that represent significant downgrades from earlier forecasts. Germany, Europe's largest economy, remains particularly vulnerable. Its high export share in GDP makes it especially sensitive to deteriorating global growth prospects, while its large automotive sector leaves it particularly exposed to potential U.S. tariffs. S&P Global notes that the weakness in Germany has been particularly persistent, though they point to some hope from a large fiscal package unveiled in March focused on infrastructure and defense spending that should boost growth from 2026 onward. France faces its own set of challenges, with high-frequency indicators remaining soft amid still elevated policy uncertainty, euro strength, and weak external demand. The UK continues to grapple with fiscal constraints that will remain a hindrance to growth, with the government facing another round of budget tightening in the autumn. However, there has been one bright spot in the European picture. Southern Europe's growth outperformance has been one of the positive surprises of 2025 to date, according to S&P Global. This has contributed to a more benign environment in sovereign debt markets than many analysts had expected. The European Central Bank has taken a notably different approach from the Federal Reserve, already halving its policy rates relative to their post-pandemic peaks. This represents a break from the normal pattern of European monetary policy following Fed policy with a lag. Based on recent ECB signals, it appears their easing cycle is nearly complete. The trade policy landscape continues to evolve rapidly, with significant implications for global economic growth. The average U.S. tariff rate, which had surged from 2.5% at the end of 2024 to a peak of 29% in mid-April 2025, has moderated to around 13.3% by July, according to the latest estimates. However, this still represents more than a five-fold increase from January levels. The impact of these tariff changes extends far beyond simple trade statistics. According to the latest McKinsey Global Survey, trade policy changes have become the most cited risk to global economic growth, with 36% of companies now identifying trade changes as a top risk to their business performance, more than double the 17% who said the same just 1 year ago. The regional impact varies dramatically. Companies in Greater China report the highest level of operational changes, with 94% making at least some adjustments to their operations. This near-universal adaptation demonstrates the profound disruptive effect of current trade policies. The United States and European Union are currently engaged in intense negotiations ahead of an August 1st deadline for potential additional tariffs. According to CNBC's latest reporting, the U.S. is playing hardball on this deadline, while the EU is battling for a deal. The stakes are enormous. Total trade between the EU and US amounted to 1.68 trillion euros, $1.96 trillion in 2024. The inflation picture globally has become increasingly complex, with what S&P Global describes as predicted divergence of inflation dynamics becoming more apparent. While global inflation is expected to decline from 4.5% in 2024 to around 3.6% in 2025, this average masks dramatic variations between countries and regions. In the United States, June inflation data showed the first clear signs of tariff-related price increases, with outsized increases in various core categories. S&P Global's PMI data continues to show relatively elevated price indexes in the US, in contrast to most other major economies. This divergence is driving the Federal Reserve's cautious approach to rate cuts. European inflation dynamics present a stark contrast. The Eurozone recorded 1.9% inflation in May 2025, down from 2.2% in April and below the European Central Bank's 2.0% target. Weak demand conditions suggest that underlying disinflationary trends will persist in Europe, reinforced by currency appreciation against the dollar. China faces the opposite problem, with deflationary pressures intensifying. The adverse effects of higher tariffs are exacerbating supply-demand imbalances and prolonging consumer price deflation. This creates a challenging environment for Chinese policymakers who must balance supporting growth while managing the deflationary spiral. One of the most significant developments in global financial markets has been the substantial weakening of the US dollar, which S&P Global describes as exceeding their expectations. The Fed's broad real effective dollar index has fallen by over 6% from its January peak, a magnitude that is particularly noteworthy given that higher US tariffs were supposed to boost the US dollar. This dollar weakness suggests what analysts describe as a waning appetite for US assets, and institutions are closely monitoring fund flows, including foreign holdings of US treasuries. The accompanying strength of major European currencies has been particularly surprising to analysts. From a level still about 15% above its long-run average, S&P Global expects the depreciating trend of the real broad effective dollar index to continue, though at a slower pace. Among major trading partner currencies, they expect the Japanese yen to continue outperforming, consistent with divergent monetary policies between Japan and the United States. The performance of major emerging market economies presents a mixed picture. While China has surprised to the upside, other major BRICS economies are showing signs of weakness that align with earlier predictions. Brazil is experiencing what S&P Global describes as a marked weakening of economic activity, with recent high-frequency data and sentiment indicators pointing to a potential quarter-over-quarter contraction in real GDP in the second quarter. S&P Global's PMI data for Brazilian manufacturing and services were both in contraction territory in June. Russia is also showing signs of broadening weakness, with May data revealing a 0.7% year-over-year growth rate in the Economic Activity Index, well below the 3.1% peak recorded in January. This deceleration reflects the mounting impact of international sanctions and trade restrictions. India continues to show relative resilience, though growth rates have moderated from earlier highs. The country benefits from its position as an alternative manufacturing hub as companies diversify supply chains away from China. Despite the challenging global economic environment, or perhaps because of it, significant investment opportunities are emerging across multiple sectors and regions. Supply chain diversification continues to create massive opportunities as companies build more resilient, geographically diverse supply networks. Vietnam, Mexico, India, and Eastern European nations are positioning themselves as alternative manufacturing hubs, creating substantial infrastructure and industrial investment opportunities. The energy transition is accelerating despite economic uncertainty. The International Energy Agency's latest estimates suggest global clean energy investment needs to reach $4 trillion annually by 2030, creating enormous opportunities in solar, wind, battery storage, and grid infrastructure. Technology adoption is accelerating as companies facing economic pressure turn to technology for efficiency gains. We're seeing rapid adoption of artificial intelligence, automation, and digital transformation across industries, creating opportunities for technology providers and early adopters. Financial innovation continues to boom through the combination of economic uncertainty and technological advancement. This is driving innovation in digital payments, alternative lending platforms, sophisticated risk management tools, and new categories of alternative investments. Looking ahead to the remainder of 2025, regional economic trajectories are likely to continue diverging. The United States faces the challenge of managing tariff-induced inflation while supporting growth, with the Federal Reserve walking a tightrope between these competing objectives. China's economy is expected to slow in the second half of the year as the effects of tariff front-loading fade and policy stimulus diminishes. However, the country's focus on high-tech manufacturing and domestic consumption could provide some resilience against external headwinds. Europe's recovery is likely to remain subdued, with growth constrained by weak external demand, policy uncertainty, and fiscal constraints in several major economies. However, the ECB's more accommodative monetary policy stance could provide some support. Emerging markets face a challenging environment, with those most exposed to global trade likely to experience continued pressure. However, countries that can position themselves as alternative manufacturing and investment destinations may benefit from ongoing supply chain diversification. Governments worldwide are grappling with the challenge of supporting their economies while managing the constraints imposed by high debt levels and changing global trade dynamics. Fiscal policy responses vary significantly by country and region. The United States faces the challenge of managing the inflationary impact of tariffs while supporting economic growth. The administration's trade policies are creating short-term economic distortions that complicate traditional fiscal and monetary policy responses. China continues to implement targeted stimulus measures, focusing on high-tech manufacturing and infrastructure investment while trying to manage the real estate crisis and deflationary pressures. The government's around 5% growth target for 2025 appears achievable based on first-half performance, though maintaining this pace through the second half will be challenging. European governments are constrained by fiscal rules and high debt levels, limiting their ability to provide significant economic stimulus. However, the focus on defense spending and infrastructure investment, particularly in Germany, could provide some economic support in 2026 and beyond. Several key risks continue to cloud the global economic outlook. Trade tensions remain the primary concern, with the potential for further escalation if negotiations fail to produce agreements. The August 1st deadline for US-EU trade discussions represents a critical juncture that could significantly impact global trade flows. Geopolitical tensions, particularly in the Middle East and between major powers, could disrupt critical trade routes and energy supplies. The global economy's dependence on key choke points makes it vulnerable to geopolitical shocks. Financial market volatility remains a concern, particularly given the disconnect between market valuations and underlying economic fundamentals. The sustained rebound in major equity indexes since mid-April suggests market optimism about trade policies that may prove overly optimistic. Climate-related risks continue to pose long-term challenges to global economic stability, with extreme weather events potentially disrupting supply chains and agricultural production. As we move through the second half of 2025, the global economy finds itself at a critical juncture. The latest data reveals an economy that is more resilient than many feared, but also more fragmented and uncertain than we've seen in decades. The key themes that will shape the remainder of 2025 and beyond include the ongoing trade policy evolution, divergent monetary policies among major central banks, the continued transformation of global supply chains, and the persistent challenge of managing inflation while supporting growth. For individuals and businesses, the current environment demands unprecedented agility and adaptability. Traditional economic relationships and patterns are being disrupted, creating both challenges and opportunities for those prepared to navigate this new landscape. The most successful strategies in this environment will be those that embrace diversification, geographic, sectoral, and temporal, while maintaining the flexibility to adapt quickly to changing conditions. Whether you're an investor, business owner, or simply someone trying to make informed financial decisions, understanding these global economic dynamics is more important than ever. Stay informed, stay flexible, and remember that periods of great uncertainty often create the greatest opportunities for those prepared to act. The global economy of 2025 may be challenging, but it's also full of potential for those who understand how to navigate its complexities. That's our comprehensive update on the global economy as of July 2025. The landscape continues to evolve rapidly, and staying informed about these developments is crucial for making sound financial and business decisions in these uncertain times.